Another day, another story. Trend analysis. Trend analysis, also known as horizontal analysis, involves comparing financial data over multiple periods to identify patterns and changes. This analysis provides insights into a company's performance and helps to identify trends that might be developing over time. For example, if you're analyzing the revenue of a company over the past 5 years, you might notice a consistent annual growth rate. Conversely, if expenses are increasing faster than revenue, this could indicate a potential issue that requires further investigation. Common size analysis. Common size analysis expresses financial statement items as a percentage of a common base, usually total revenue for the income statement and total assets for the balance sheet. This approach allows for easy comparison between different companies or different periods within the same company. By converting financial numbers into percentages, you can readily identify the relative proportions of various components. For instance, a common size income statement can show what portion of revenue is attributed to the cost of goods sold, operating expenses, and net income. Percent change analysis. Percent change analysis calculates the percentage change between two periods for various financial items. It helps assess the growth rate or decline of specific metrics over time. For example, if you're analyzing the increase in net income from year to year, you can calculate the percentage change as net income in current year, net income in previous year. Net income in previous year, *100. Tying the ratios together. Tying the ratios together involves interpreting and analyzing different ratios collectively to gain a comprehensive understanding of a company's financial health and performance. Each ratio provides a specific perspective, but it's their interplay that paints a more complete picture. Here's how to tie various ratios together for a deeper analysis. Profitability and activity. 1. High profitability ratios, such as gross profit margin and net profit margin, combined with strong activity ratios, like inventory turnover and accounts receivable turnover, suggest efficient operations that generate healthy profits. Liquidity and leverage. 1. Assess liquidity ratios, current ratio and quick ratio, alongside leverage ratios, debt-to-equity ratio and interest coverage ratio. 1. A high liquidity ratio might indicate safety, but if it's paired with high leverage, the company may face difficulty in servicing its debt. Return on investment, ROI. 1. Combine profitability ratios, net profit margin, with asset utilization ratios, total asset turnover. 1. A high ROI results from the efficient use of assets to generate profits. DuPont analysis. 1. Use the DuPont analysis to connect profitability, net profit margin, asset utilization, total asset turnover, and financial leverage, equity multiplier. 1. It breaks down ROE to reveal the sources of its change. Earnings quality and cash flows. 1. Analyze profitability ratios alongside the quality of earnings. 1. If net income is growing but cash flows aren't following suit, it might suggest aggressive accounting practices. Market ratios and growth. 1. Consider the relationship between market ratios, P/E and P/B, and growth. 1. High P/E ratios could indicate high growth expectations, while low P/B ratios might suggest undervaluation. Comparative analysis. 1. Compare ratios with industry averages or competitors to assess relative performance. 1. A high liquidity ratio might be good, but if competitors have a better ratio, it might indicate inefficiency. Trends over time. 1. Analyze ratios over multiple periods to spot trends. 1. If profitability is declining while debt is increasing, it could indicate financial strain. Cash flow analysis. 1. Tie ratios to the company's cash flow statement. 1. A company with strong profitability but weak cash flow might delay expenses or inflate revenue. Overall assessment. 1. Use a holistic approach to tie together different ratios and factors. 1. For instance, strong profitability ratios are valuable, but if a company's liquidity ratios are deteriorating, it could face difficulties in the future. Return on equity, ROE, is a widely used financial metric that measures a company's profitability in relation to its shareholders' equity. While ROE is valuable for assessing a company's ability to generate profits from shareholder investments, it's important to be aware of its limitations and potential problems when interpreting its implications. One. Incomplete picture. ROE focuses solely on the relationship between net income and shareholders' equity. It doesn't consider other factors such as company size, industry norms, or the efficiency of asset utilization. A company with a high ROE might have achieved it by using excessive leverage, which could lead to higher risk. 2. Debt impact. Companies can boost ROE by increasing debt, which magnifies returns but also amplifies risks. High levels of debt can make a company vulnerable to economic downturns or interest rate fluctuations, potentially compromising financial stability. 3. Lack of context. ROE doesn't provide context about the underlying factors that contribute to profitability. A company might have a high ROE due to financial engineering or cost-cutting measures, rather than sustainable growth or operational efficiency. 4. Industry variability. Different industries have varying capital structures and risk profiles. Comparing ROEs across industries can be misleading, as what's considered a healthy ROE in one industry might not be suitable for another. 5. Manipulation potential. Companies might manipulate financial statements to artificially inflate ROE. Creative accounting practices can distort reported earnings and equity figures, leading to misleading ROE calculations. 6. Quality of earnings. ROE doesn't differentiate between sustainable and non-sustainable earnings. A company with low-quality earnings might have a high ROE in the short term but struggle to maintain it in the long run. 7. Equity growth. If a company raises additional equity capital, it can lower its ROE even if the earnings remain constant. This could lead to misinterpretation of the company's performance. 8. Neglecting dividends. ROE doesn't account for dividends paid to shareholders. A company with a high ROE might not necessarily provide substantial dividends, affecting shareholders' actual returns. 9. Ignoring risk. ROE doesn't incorporate the concept of risk. A company with a higher ROE might expose shareholders to greater risks, and it's essential to assess whether the increased return justifies the higher risk. Thanks for watching.